Welcome to the Daily Update Podcast, where I'll go over the action in the market for Tuesday, December 2nd, and we'll see how things look for Wednesday, December 3rd. Tuesday saw another very quiet, low conviction session. The S&P 500 closed up 0.25% at the 68.29 level on below average volume, essentially a non-trending range-bound day. The S&P opened right at the daily R1 pivot point near 68.38, immediately ran into the psychological resistance level at 68.50, dipped back down to the unchanged line for support, chopped sideways most of the day, and finished just below R1, a classic inside day with little directional conviction. The ADX, our trend indicator, remains below 20 on all time frames, short, intermediate, and long term, confirming that there's no trend in place, although the directional bias continues to lean positive on the short, intermediate, and longer term time frames. Some key positives on the bullish side. The short and intermediate term momentum is fairly strong, with the Stochk RSI, Williams percent R, and stochastics staying solid. In the intermediate term, the PMO is crossing positive, and the TTM squeeze continues to be positive. Tech and semiconductors led on Tuesday with the SMH ETF up 1.83%, the tech sector flashing a bullish MACD crossover, and the BPI for tech is now also crossing above 50. Mega caps were mostly green, with Apple closing at a new all-time high. Breadth remains constructive. Both the McClellan Oscillator and Summation indexes are declining but still above zero, and the bullish percent indexes continue to climb for the S&P, NYSE, and Nasdaq 100. There remains a potential ZWAG NYSE breadth thrust, which right now is unconfirmed but could be confirmed by this Friday. That would be a strongly bullish development if achieved. Seasonality flips to be more favorable as we move into mid and late December, and currently gamma exposure remains supportive. Looking over the key concerns, there are several yellow and red flags that persist. Growth continues to significantly lag value across the large, mid, and small cap ratios. Discretionary to staples remains short-term negative, evidence of ongoing defensive rotation. The confirmed Hindenburg omen from October is still in effect. The Chaikin Oscillator, a smart money indicator, and the Vortex have now turned negative, and the Swinland Trading Oscillator is declining based on price and volume. Valuation still remains stretched, but has for a long time now, with the top 10 stocks concentrating 41% of the S&P 500's market cap, and the S&P still remains more than 10% above its 200-day moving average, a zone that historically increases the probability of larger pullbacks. The 10-year yield dipped slightly on Tuesday, but we're watching any retest if it starts to climb to 4.5%. So far, we're quite far away from that. Other notable points. There were no major economic reports released on Tuesday. On Wednesday, the data is pretty heavy, with ADP employment, ISM services, JOLTS job openings, and factory orders all getting ready to hit the tape. In some intermarket analysis news, Bitcoin is attempting a rebound, though its correlation to the Nasdaq 100 continues to weaken. The dollar remains soft, unable to reclaim the 100 level with the US dollar index, and crude oil is sliding into the 58 range. Sentiment gauges are mixed. In the longer term, sentiment remains positive, but on a short-term basis, the fear and greed index remains extremely pessimistic below 25. Looking ahead to Wednesday, December 3rd, the big picture view has not changed very much. The short and intermediate term trends are positive, but we're not trending. Momentum is continuing to hold up for the time being. In the longer term, the S&P is bullish, but extended and considered to be overvalued. Currently, the S&P 500 remains in a show-me phase. The market needs to either 1. Show more growth leadership as it reasserts itself alongside a confirmed breadth thrust, or 2. Some catalyst in Wednesday's data or geopolitical event to break us out of this low conviction chop. Overall bias into the year-end remains cautiously optimistic on seasonality, but the growth to value divergence, a lingering Hindenburg omen, overvaluation, and defensive rotation keep us from turning aggressively bullish. Thank you very much, and I will talk to you in the next podcast.